Collateral Revolution: How Crypto Infrastructure Will Eat Wall Street and Replace Central Banks. 1. Introduction: The Coming Age of Crypto Capital Machines. Crypto didn't start with Wall Street's permission, and it certainly didn't ask for a license. It began with a single white paper, a network of believers, and a growing dissatisfaction with the financial system's inefficiencies, opacity, and gatekeeping. 16 years later, what began as a monetary experiment has matured into a full-blown financial OS. This isn't just about coins or speculation anymore. This is about infrastructure, the digital plumbing that will power the capital markets of the next century. Where traditional finance traps liquidity behind layers of siloed accounts, outdated rails, and slow settlement, crypto offers an entirely new model: instant, composable, and permissionless capital orchestration. It's a system where your wallet is your bank, your assets are your collateral, and your trades settle in real time, globally, 24/7. And now, the builders of this new world, exchanges, stablecoin issuers, custodians, and protocol architects, are stepping out of the shadows. They're going public. They're gaining market share. They're building systems so efficient, so adaptive, that legacy finance is beginning to look like a typewriter factory watching the iPhone launch. This is not just an upgrade. This is a revolution in collateral. And whoever controls the collateral layer controls the future of capital. Section 2. The collateral crisis nobody talks about. In traditional finance, collateral is everywhere, but never where you need it. You've got one margin account for equities, another for futures, a third for FX. Want to trade across them? Tough luck. Your capital is locked in fragmented silos, each with its own haircut, its own margin rules, its own obscure risk engine. It's a world of duplication, friction, and dead capital. The inefficiency is staggering. Entire trading desks are forced to over-collateralize just to maintain optionality. Hedge funds dedicate full-time ops teams just to move money across systems fast enough to avoid forced liquidations. And even then, it fails. See Archegos. But here's the kicker: the technology to fix this already exists. Crypto didn't inherit those silos. It started from scratch. No clearinghouse? No problem. No prime broker? Even better. Crypto-native exchanges built systems where a single asset, say ETH, could be posted as margin for trades in BTC, SOL, or even tokenized oil futures. At its best, crypto introduced the idea that your portfolio isn't a stack of disconnected assets. It's one unified pool of economic energy. And if you design the margin engine right, that energy can be reallocated, hedged, or deployed at the speed of thought. This was the unspoken truth behind every capital-efficient crypto platform. They solved the collateral crisis before Wall Street even admitted it existed. Section 3. The Innovation Leap: Unified Collateral Models. The first true innovation wave in crypto wasn't DeFi yield farming or NFTs. It was the invention of capital efficiency as a product. That moment arrived when Arthur Hayes introduced the perpetual swap on BitMEX, a derivative that never expired, mimicked spot price behavior, and required minimal capital to control massive exposure. It was elegant, dangerous, and wildly effective. A new instrument was born, one that now clears billions in daily volume, and not just on BitMEX. But the second wave, that came with FTX's unified collateral model, a masterpiece of financial UX. Instead of forcing users to segregate funds into isolated silos for spot, perps, and options, FTX let everything flow through a single account balance. Your BTC, ETH, USDT, FTT, all treated as collateral, each with its own haircut. The system dynamically adjusted your margin availability based on real-time prices, cross-asset risk, and portfolio exposure. You didn't have to move funds to trade something. You didn't even have to think about where your funds were. Everything was margin. Everything was in play. This was not just a quality-of-life feature. It was a conceptual breakthrough. It changed how traders thought about risk. It made advanced strategies accessible. It made collateral itself programmable. And for a brief moment, the world saw what finance could feel like when built natively digital. Of course, we all know what came next. SBF torched the empire he built, not because the product was flawed, but because the man couldn't separate genius from greed. Still, the model lives on. Bybit's Unified Trading Account, UTA, brings multi-asset support into one capital pool. OKX's multi-asset mode allows for dynamic margin reallocation across contracts. Deribit's XPM system enables precise margin calculations across crypto options, futures, and perpetuals, all in a USD-based risk matrix. Crypto's best minds didn't stop building, they just stopped trusting figureheads. The code, the concept, the collateral architecture, all still here, all still improving. Section 4, the UX that could have ruled the world and blew up. FTX was a unicorn, but not in the way Silicon Valley meant it. It wasn't just the fastest growing exchange. It was the first platform to make collateral management feel invisible. You didn't need to understand capital markets to wield them. You just needed a wallet and conviction. From the user's perspective, it was magic. You could rebalance your portfolio by simply swapping between assets in the margin wallet. Want to pivot from a stablecoin heavy stance to a BTC long bias? Do it right there. No extra funding transfers, no new margin subaccounts, no delays. Risk was presented intuitively. Liquidation thresholds were dynamic. Haircuts were transparent. It wasn't just an exchange. It was a live simulation of a frictionless global bank, built for the individual. That's why when it collapsed, it didn't just destroy trust. It broke the hearts of serious traders who had finally found a system that respected their time, their capital, and their intelligence. SBF didn't fail because the platform was flawed. He failed because he believed the same seamlessness that powered the UI could apply to ethical shortcuts, balance sheet games, and backdoor access. It was the most tragic fusion of brilliance and betrayal the industry had ever seen. And yet, the architectural blueprint he helped normalize, a unified collateral layer, survived. Builders picked up the shards and rebuilt, this time with more control, clearer rules, and a deeper appreciation for what was almost lost. Section 5, IPO Wave, Infrastructure Comes Above Ground. The next chapter in crypto's maturation is no longer theoretical. It's happening on public markets, the final boss arena of legitimacy. Circle, the issuer of USDC, arguably the most trusted stablecoin in the world, filed to go public and has been actively preparing for its debut on U.S. stock exchanges. Kraken, one of the longest-standing crypto exchanges with a clean regulatory record, is reportedly aiming for a direct listing, poised to enter the public eye with institutional confidence. Even Tron, long dismissed by critics as a gimmick chain, has announced its intention to go public, a signal that even the legacy alt projects are stepping into the light. Meanwhile, crypto mining firms like Riot, Marathon Digital, and Hut8 have already been trading publicly for years, serving as proxies for Bitcoin exposure in traditional portfolios. These aren't just crypto companies anymore. They're capital market primitives, rails, routers, and routers of value. And unlike the over-leveraged fintech unicorns of the last decade, many of these firms are cash flow positive, globally distributed, and protocol integrated. They don't just plug into the future, they're building it. Going public isn't just a liquidity event for crypto firms, it's a signaling event to the world. We are here, we are credible, and we are infrastructural. The IPO wave is not just about shareholder access, it's about staking legitimacy on the global financial stage. And every listing represents another milestone in crypto's irreversible integration into the architecture of tomorrow's economy. This content is brought to you by Bobby Gigs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. 6. The larger vision, crypto companies as the new central banks. At the heart of every financial system lies a question: who controls the collateral? In the 20th century, that answer was simple: central banks. They issued the money, they managed the reserves, they acted as lender of last resort. But that monopoly is cracking. Today, crypto infrastructure companies are quietly replicating and in some cases improving those same functions. Stablecoin issuers like Circle and Tether have become private monetary authorities, issuing dollar-denominated units of account that settle instantly, globally, and permissionlessly. Exchanges like Binance, Kraken, and OKX have become synthetic clearinghouses, managing leverage, settlement, and collateral valuation across tens of billions in open interest, without the need for an interbank market. Custodians like Coinbase Prime, Fireblocks, and Anchorage act as private vaults, safeguarding assets with hardware-backed security and compliance layers that rival sovereign systems. Protocols like MakerDAO and Aave are autonomous credit engines, issuing loans and generating yield backed not by decree, but by transparent on-chain logic. This is not just fintech evolution. This is monetary parallelism, a world where crypto-native institutions perform the exact same functions as central banks, but with greater speed, higher transparency, programmable enforcement, borderless access. It's not that crypto companies want to replace central banks. It's that they're already doing their job better. When a user holds USDC, borrows against ETH, stakes SOL for yield, and trades BTC perps using all of the above as collateral, who really controls the monetary base of that person's world? Spoiler, it's not the Fed. 7. Rallying cry. Tokenize the whole fucking world. This isn't just about trading efficiency. This is about rewriting how value moves, how assets are born, and how capital is allocated in the digital age. Give us clear regulatory frameworks, hell, even tolerable ones, and we will tokenize the entire world economy. Equity? Tokenized. Real estate? Fractionalized and tradable 24/7. IP royalties, carbon credits, energy contracts, loyalty points, yield rights, even time itself, turned into liquid primitives in a universal collateral pool. And all of it will be settled instantly, collateralized universally, interoperable globally. The unified collateral model isn't a niche idea. It's the operating system for a global marketplace without walls, where every asset can be plugged into every other, rebalanced with one click and deployed as leverage in any market. No more siloed accounts. No more two-day settlement windows. No more accredited investor nonsense for participating in value creation. Just pure digital capital flow, optimized by code and owned by users. This is not a product roadmap. This is an inevitability. And to those who say it's dangerous, chaotic, or premature, we say this: the old system has had a century. Let the new one try. Because the truth is, we're not trying to replace finance. We're trying to liberate it. So get out of the way, or get run over by the most unstoppable monetary movement since the printing press. 8. Conclusion. Crypto is not a sector. It's a protocol stack for the next civilization. Crypto is not an asset class. It's not a trend or a hedge or a speculative bubble. It is an operating system for the coordination of global value. We've spent the last 16 years building the foundations. Bitcoin gave us incorruptible money. Ethereum gave us programmable contracts. Stablecoins gave us real-world liquidity. Exchanges gave us global settlement layers. Collateral engines gave us capital efficiency never seen in legacy markets. And now, crypto companies are becoming banks. Protocols are becoming markets. Wallets are becoming sovereign vaults. This isn't the fringe anymore. This is the core stack of the next economic era. We will see nations integrate crypto into their sovereign reserves. We will see decentralized systems outperform central planning in capital formation. We will see the first digital banks that don't need charters because their trust is rooted in code, transparency, and user custody. The future won't be built on quarterly earnings calls and 10-year bond auctions. It will be built on real-time collateral, programmable flows, and permissionless innovation. Crypto is not a threat to the financial system. It is its successor. And the builders today aren't startups. They're proto-sovereigns laying the groundwork for an open, global, interoperable economy. The collateral revolution has begun. The ledger is live. And the only question that remains is this: will you build on it or get left behind by the most important financial transformation of our time?